Hello, welcome to Green Bicep. This is week number 13. Let's get to it. Signal from the noise. So the market was down over the last week, about 1% to 0.5% year over year. We're down 15 to 20%. So we are still in a downtrend big picture. The rubber band is being stretched and eventually it will let loose, and that means the market will likely reset itself to a lower level. Currently, the market has several rate cuts priced in, so if the Fed doesn't cut rates several times this year, you could expect a pretty good correction. At a target of 3,000, it's quite a bit lower, but it's realistic. Treasury's working with the banks to plug holes. The problem is that the banks bought commercial mortgage-backed securities. When you deposited your money into a bank, they were like, they took that and they bought some bonds. Now those bonds are trading at a loss. So if they sold them, they would lose money on them. And because of that, certain banks can't. If everybody came in for their money, they couldn't provide that money back. I mean, that's fractional reserve banking in general, but in this situation, it's more compounded because they don't have liquid assets in general. And we'll get more into that. We'll talk about reverse repo and the money market funds. So investors in Silicon Valley Bank, one of the large investors was General Atlantic. Interesting enough, they own part of TikTok, and TikTok is under scrutiny with the U.S. government. And so yeah, this company, General Atlantic, they have a lot of ties to the Communist China, the CCP. Federal funds rate is at 5%. 25 basis points was increased. There's chatter of more hikes, which is shocking. We're on March 29th. It's like 6 in the morning. And there's talks of raising rates more, which is, I think, it ultimately, it would reset the system. And so that means like current state, like if you have a HUD loan, they're actually making it so if you can't make your payments, they're extending the loans to 40 years and you're deferring the loans on mortgages. And that's happened with HUD and maybe other types of loans too. So the structure's been put in place so that I believe the consumer will be protected. There's going to probably be fiscal stimulus coming. And they're going to let these banks wash out because there's just a malfeasance and just a lot of dirty money. Just like with this whole TikTok, why would General Atlantic, have so much money in Silicon Valley, TikTok plus eHarmonies and associated with it? It's a data collection aspect for the folks on the east side of the hemisphere. So oil got a bid, and Buffett added to Occidental Petroleum. So I would consider that when you want to own. And oil is at a low now, so it's probably a good time to actually look at Valero. A lot of these high quality names out of even Canadian oils. Cenovus out of Canada is a hot name I've heard recently, and it has great multiples. So now we're talking about more the ASEAN area, which is Malaysia, Indonesia. They have 650 million people. I think this is the area to watch for activity. I think the U.S. is going to want to take control of that territory to use for manufacturing. I know we're going to bring a lot to the United States, more of the chips and sensitive areas, but I think this is going to be an area of contention, and I don't think it's going to be that far off. I think it's in the next 5 years. And that's not, I'm not talking about Taiwan. I'm talking about we have these young people here where our demographics are, we're not horribly off. We're not like China or some of these other countries, but it's going to be important to our future having people, young people. Because when I'm 65, I'm not going to want to be working anymore. Well, I want to work, but I'm not going to want to work like 40, 50 hours a week. Or Middle East tension. So that's not in focus, but Iran bombed 3 U.S. bases. We retaliated. And then this just happened yesterday. The Azerbaijan, the prime minister, the Iranians attempted to assassinate him, and they weren't successful, from what I hear. So that just happened as well. So things are really heating up there in that area. China. Yeah, this is just from last week. It's just the Belt and Road Initiative is all the countries that China's worked with all throughout the world, Central America, South America, just helping them out essentially. And this is part of their plan. It's codified in writing where they'll actually roll out their CBDC eventually. And I think that's going to be actually sooner than later, presuming it, sooner than later. They've been testing it in China for a while. So what that means is they could deposit like $50 into someone's account, and that money could expire after 30 days, or it could be designed, if they have the technology, to use on just certain types of goods. So it's very powerful, and it's actually quite scary if you have a bad government. So this is a big deal. Q1 earnings are kicking off here shortly. Today, like I said, it's end of March, and so we're likely going to see a lot of misses, but the story is really guidance, what they're saying about 2024. So, some of these leaders will likely not actually talk about it. So they could try kicking the can another quarter, and that would ultimately mean, the market will correct even that much harder in a quarter from now. But I think the analysts are smart enough to figure it out. If you're seeing inventory start to balloon, there's obvious signs when the economy's weak, and you would publicly traded companies. I have Starbucks on here because I noticed that the import or exports out of Brazil as well as Colombia are way off, and I know Starbucks gets its coffee from there as well as in Asia. And then on top of that, it's technically the chart looks like crap too, and it just seems right for and also the price of coffee's gone up a lot, and I know they hedge coffee prices, but still at the same time there's just a lot of headwinds. And so if the consumer's being pinched, I would expect Starbucks to lower guidance some. So I think this is poised, plus their PE is like I think forward, or it's like in the high 20s to 30s. So it's just overvalued. Then you get these oil companies like Oxy, we talked about Occidental, or you get Rig, they're trading at PEs of under 10. So there's a lot of cash-rich companies out there. It's just the analysts or the market hasn't woken up, and there are algorithms that are driving some of these investments. Like BlackRock uses a software called Aladdin, which I think is a risk to society, in the sense that if that is allocating assets based upon this Aladdin could say whatever, and then you get this big sell-off. But that's besides the point. But Aladdin really needs to be starting to invest in high-quality names. But the reason it hasn't really is because this whole environmental social governance issue that's been being pushed across the world, ESG, by the World Economic Forum. And so, perfect example, Colombia, they have oil, but they're not allowed to start any new exploration of oil in Colombia because of the World Economic Forum, because if they don't, they'll get cut off funds. I don't know what the political ramifications are, but hopefully they'll push back on that. And so this decentralized group without a country are dictating geopolitical legislation and constricting energy. And I think it's a huge concern, and Powell's aware of it with the Fed, and Jamie Dimon's aware of it, and the good guys are aware of it. And here we are, the market. So this is just the trend of the market since December. You can see downtrend. Well, this is actually an uptrend to a degree, is the NASDAQ. But the interesting part is when you look at the advanced decline line, this has been going down while the NASDAQ went down, then went up. Generally, when you have this occurring, meaning this is not increasing advanced decline while this is going up, this will reset back to 11,000 easily. So that's a bunch of fluff. Russell's going down. And another thing, when you look at the market in current state, the small caps have been getting destroyed. So eventually we're going to see the big guys start to roll over, and it looks like the Apples of the world are finally rolling over when you look on a bigger picture basis from weekly to monthly. And so we're finally going to get that washout. I don't know how much more they can stretch it. So the economy, where are we at? Michael Kantrowitz has his HOPE acronym: housing, orders, profits, and employment. This is the most beautiful thing someone created. He created. And so in the cycle, you see housing flipped over, orders have gone down, durable good orders just now we're at the point of profits. Now Q1 profits are going to be reporting, so this is going to start to, earnings are going to drop off, and then he's estimating mid 2023 we'll see initial jobless claims shoot up. And I agree, it's going to happen. The thing is, there's going to be a lot of fiscal stimulus, as well as, like we talked about, the mortgage. So it's, things are, claims are going to shoot up, earnings are going to get squeezed. Probably high-end retailers will do really well for those that don't get, in the high end. And then you're going to have a discretionary type things that are not required. Like if you have an RV company, they probably won't do very well. And there's a few publicly traded RV companies, and they're actually trading at high multiples. And yeah, there's one, THO is the ticker, and its revenue is like off. It's just ridiculous, and I'm surprised how high it's trading. It hasn't collapsed yet. So there's a lot happening, and so essentially what this is saying is the economy is weak, and hasn't flushed through it yet. And so be safe, have cash and gold. That is what I would recommend to any student if I was teaching on this stuff. Michael Kantrowitz, this is illustration of the cycle. So it's looking at housing, orders, profits, employment, but it's instead in this case it's vertical and it's more detailed. You can see right here, this is the Fed inflation kicking up right here. Initially, inflation kicks up, and then you see the Fed starts to raise rates. That's the federal funds rate, and then you can see consumer confidence gets kind of negative right here, and then improved. And this is in 2006. And then you see next permits, housing permits started dropping off. Then eventually you got the S&P 500 turning down. Then you eventually got sales, industrial productions, capital good orders. Looks like capital good orders actually started weakening early, which makes sense. But it's you could see it down here, and a lot of CapEx stuff is planned out a year or farther ahead, and so that you typically will cut things that don't impact revenue first. So that's why it's like lumpy, and then people like typically will play with the budgets. So then you got new orders, consumer number. I don't know. That's likely retail sales. Then you finally get into, so if we go back up, it's housing falls first, durable good orders in general. Then it goes into corporate profits and employment. So then we're down to get to, we're getting into where is corporate profits. Personal income, payrolls. I guess it's not in here. I guess this is all a function of that. So yeah. So, but you could basically see how the cycle rolls from a time frame of May of inflation started kicking up in 2004, and the cycle didn't play out until 2009. So it takes time. So here's the 5-year credit default swap on USA debt. It's really jumped up a lot. So that ultimately means that it costs more to purchase insurance on the U.S. government bonds. I mean, it's likely nothing, but the point is it's there. Meaning, when I say nothing, it's just not material, the cost today, but it shows that other people are looking at our debt, and there is some concern. I'll look in here this is Chinese imports. The reason why I put this on in here, China is opening, but it's been weak. I mean, it started going up, and now it's definitely not very strong. So they're gonna have to figure something out if they're gonna want to get real growth instead of just printing money. And so you can see these are the top trading partners with China, and it's sorted by it looks like I sorted by imports, which is correct. And then Taiwan is up there, South Korea, Japan, etc. And so then if we look at the trend of Taiwan, Japan, and South Korea, you can see that imports really dropped off, or these are their exports for Japan exports, Taiwan exports, South Korea exports, so it's Chinese imports, a certain percentage. And you can see Japan's just, I don't know what happened there. Did they hard code it wrong? And then South Korea has really dropped off, and then yeah, Taiwan. So it doesn't look great for China. Well, their money supply is like shot up, so they're printing a lot of money, but it's not really too accretive. This is Kwan. He ran a giant Ponzi scheme in the billions of dollars, and he's saying, when will they arrest CZ? CZ is with Binance. He's actually a good guy. It's just the U.S. decided to target him, and they're just looking for a reason to blame him. And I see CZ getting arrested, and somehow Sam getting away for free for FTX. That's my theory of what's going to happen. So it would be bad for Bitcoin over the short term. Then if the U.S. does want Bitcoin to survive, they'll keep a few access points open in the U.S., such as Coinbase and Kraken. And then Bitcoin will surge. If they want to close Bitcoin down, they'll close those exchanges, and that'll be it, and it'll struggle. So we're at a critical point with that asset. Putin, I threw this in here as a reminder. Putin and President Xi of China, they've been meeting a lot. They're buds. Tons of deals signed. Iran, Syria. It's getting real. Like, the whole region is tightened up. They're all becoming great, strong allies. Yeah, so watch troop movements now of the U.S. If we get a lot of troops moving to like Australia, then you know we're planting the groundwork to defend Taiwan. Household debt and credit. So this is the banking system as a whole, and this shows uninsured depositors is at $7.9 trillion. So that, I mean, technically there are people that have over 250 that still get insurance. So this isn't like 100% accurate, but it's in the trillions, you would say. That's 46% of total assets, according to this, minus exclusions. Yeah, that doesn't seem right. Because we have way more than, well, the 79 is a right number, but the 49, so yeah, so it's a pretty relevant number, being in the trillions of uninsured. And the point of showing this is just saying there's risk, because people feel they're uninsured, they're going to pull their money if they feel they are uninsured, even if they are insured and aren't aware of it. We'll get into this overnight repo. This is where banks are parking their money, and so we highlighted this before, it's been trending down, so they're putting less money into the Fed because they need money now. Prior, they were parking a lot of their commercial mortgage-backed securities there, and then getting some yield on that, or parking whatever asset they chose. And so you can see here the smaller banks' assets have dropped quite a bit. Looks, yeah, 4.9, that's got to be trillion. And then here I threw this in to illustrate that credit contraction is happening, and this is Europe, ECB. The point of this is happening in the US, and once credit contracts, the economy slows down. And so it's on top of having rate increases, we're getting credit contraction because banks are going to shutter, or they're going to lend less because they don't have money. They're going to be giving away free toasters and stuff to get you to deposit their money. So credit's going to contract, and this is going to really squeeze the economy even farther. I think the models, a lot of people have it wrong. Banks are scrambling to raise cash. This is just showing it. This is the discount window where banks actually go straight to the Federal Reserve to borrow money. And you can see 2008, it looks like, what was that? That's the S&P, but over here is what was borrowed. And so they borrowed, it looks like $160 billion or so in the last like week or so. much greater in 2008. You know how 2008 went. These are the banks with exposure. So as you go to the right, this is unrealized loss. So like SIVB had a lot of unrealized losses on their balance sheet, number one of them all. And then on this axis is the percent greater than 250,000 of the bank that's deposited, meaning if 75% of your people had more than 250 invested, they would be up here at 75, right around this line. So this means that a lot of really wealthy people had their money in SIVB, Silicon Valley Bank, and they had massive amounts of unrealized losses. So unrealized loss is a big deal. So if you come in here, it looks like Bank of America has a lot. It's like of their certain classification, their classified capital, but USB, Co-America. This is First Republic trying not to go bust. SBNY, I think they went bust. Yeah, so this whole quadrant is of concern. I think this quadrant is of concern too, actually. But we don't want to really talk about that. I'm saying that they don't want anyone talking about that. So bank exposures. Norway's central bank, I highlighted this last time. The point is they have 129 billion invested in financials. So, and they own a lot of Apple. They own a lot of NVIDIA. They own a lot of, I think they might own even, I'm not sure if they own Roku, but they own a lot of stuff they're going to have to sell likely because they got to keep their portfolio balanced. And so they're losing money on the financials, so they're going to have to rebalance. And they likely own quite a bit of fixed income, which is probably the commercial mortgage-backed securities. And that's what ultimately caused the pension bank run in the UK, is where they kind of get liquid assets because they're invested. Because when you invest money in a money market fund and it says you're going to earn 5%, how do they earn that 5%? You got to think about that. And this is the answer. So Vanguard Federal Money Market Fund, they're putting it into the repurchase agreements. 57% is going to the Fed. So you're giving them your cash. So Vanguard's taking your, say, 10K, giving 10K to the Federal Reserve. The Federal Reserve is likely giving them commercial mortgage-backed securities or something in return. So they sit that on their balance sheet. The problem is the value of those CMBSs have dropped tremendously. So it's something worth noting. Yeah, so the money market funds technically are not liquid, and if I'm wrong, yeah, the whole thing is, will the Fed buy them back at par, or they're going to buy them back at market price? If they're going to just buy them back at market price, then it's fine. These are liquid and the Fed's going to eat it. I personally don't think the Fed's wants to own these commercial mortgage-backed securities, and that's why the banks are holding them, and that's why the banks are going bust. And that's also why ultimately the Treasury will keep it pulled together, and that comes back to the taxpayer. I think they want to push the losses on the taxpayer of these. Because what happened was these New York City buildings are empty because of COVID. So they're missing payments, right? And the people that own the buildings, the owners of the debt, they're ones that sold these debt securities. And eventually it found its way into the Federal Reserve via the reverse repo market we showed. Wherever it was. Right there. So this is all commercial, I think, commercial mortgage-backed securities and other securities being deposited into the Fed. So the Fed has this giant balance sheet of a lot of garbage. And the Fed wants to get rid of that, and so now the banks took a lot of it back, and the Fed still owns tons, but at the same time, the Fed needs to stay solvent. So I think we're playing a game of hot potato. And so you're looking at money market funds. If this started. So market moves higher when the Fed expands its balance sheet. This is a repeat from last week. It's just worth noting. Fed's balance sheet tapers off, then the market corrects, it corrects again. Balance sheet's up, it starts to taper off. It's not a perfect correlation, but it's legit. And then right here, according to this is 97% correlation. So it's worth watching. And the Fed's balance sheet did expand recently by like 400 to 500 billion. And the market's held together pretty well, while also having that rate cut priced in. All right, so what we're talking about, going back a little bit, we're supposed to be talking about consumer debt, right? Household debt and credit, and somehow I threw in a few extra slides. So let's get back to so the total debt balance by age, and here you can see that obviously the amount of debt has increased, and it's expanded by age groups quite a bit, more so on the 30-year-old, the 39 I think the most, and then 40, 49 maybe second most. It's hard to tell, but it's expanding. Trillions of dollars of debt. So we're at like 17 trillion or so. And then this is auto loans 90 days past due. And so that's finally starting to kick up. And this is probably lagging like several months as well. So the consumer's being squeezed. Here, mortgages are not late yet. So the 90 days late is turned up some, but I guess it is happening. So you can see right about here, and that's what I've noticed. Everything's like really in 2021's when this recession stuff, like things started really going bad. And you can see it here, 2021 to 20, it started kicking up, people being late. So the economy really, this has started a long time ago. Then they started raising rates. They're gonna destroy people. So what is holding things together is this credit card limit. So if you compare to 2008, there's much more available credit right now. But the interesting thing is 2008, we're at this line here using, I don't know if this is, yeah, I guess $1 trillion or so, almost $1 trillion in credit was used. We're actually past that now. So we're using more. Obviously, there's more people, but the point is there's a lot of credit being used, but there's a lot more available. But the banks are going to cut this back likely. So this, I would expect to go below the 2008, but unless the Fed or someone, Treasury or someone says you can't cut it back. But historically, they'll cut it back, and I think they will, because otherwise they won't survive. Because they have certain ratios they got to maintain at the banks, or even credit card companies. So the bottom line is this could stretch things out farther for longer because there's so much credit available. So the consumer is just going to be bleeding, putting themselves more in debt every month. Yeah, this is old. Prior, I couldn't find. I'm going to update this, but it's just showing that the bottom 50% are just their credit card as a percentage of all credit is just ballooning. So the poor, or bottom 50%, are the ones. When the Federal Reserve raises rates, all it does is pass assets from a debtor to a creditor. It's really good for the people that own the businesses. That's all it does. The real way they should address this is by adjusting money supply. And that would have forced rates to change, but it would impact the corporations more quickly. Or more, it would be more on them and less directly on credit card, HELOCs, and floating debt, which is like small businesses. And so this is, in my opinion, an attack on small business as well as the average consumer. There's other ways you could address inflation if you're concerned with it. And maybe the bigger picture is they want to wash all these banks out, and they plan on having at least 30, 50 banks go bust. But I don't have it in here, but last week we had it was like several hundred banks went bust. I think it was looked like 500 or so during the 2008. We're going to probably have, I don't know if it'll be that high, but it's going to be, I would imagine, at least 100. So total, this is the money chart. This is total debt balance per capita. So that's looking at per person essentially. And when you compare like Arizona from 2008 to now, we actually have more debt per person now. And then you can see it's quickly approaching in California, the peak. And we're still kind of early in the cycle. Like this is going to be 2024. if we're lucky, we bought them in 25 the way, unless they just print up the wazoo and do a lot of stimmy checks, and they basically a great reset and force everybody to, yeah. So the dotted line here is actually exceeding 2008, and the dotted line is the national average. Oh my goodness. Unofficial sponsor is Monster. Thank you for providing me this. So for those bulls out there, you could go smoke a big cigar, because I think, yeah, unless they, yeah, this is like cut interest rates 100 basis point. Yeah, even like they would have to like reverse everything immediately, and they're not going to, because their plan is much more bigger than just the consumer. I think it's really about the SVBs or Silicon Valley banks of the world. Baker Hughes, the rig count actually increased. Woohoo! So that's a good sign. I mean, I think once you see capital investments start to push into oil, then you're going to see everything start to, oil stocks take off. And I get the feeling we're at that point where the pension funds of the world don't have a lot of allocation to oil. So now's the time to buy. You might have to hold for a few years, and you own the high quality U.S. stocks. You'll be okay. And there's a lot of them. It doesn't take very much research to figure out. Look at what Buffett's owning, some of the better hedge funds in the world, or then you'll have an idea. Saying all that, given the contraction going on and everything like that, it's like we're like in a situation where like people think we're worried that oil prices are going to stay low because there's just not a lot of demand. China's not open up, but the fact is, the rig count continues to drop, and countries around the world continue not to reinvest. This is more of a 2024, 2025, really 25 on thing. But in order to get the price now, you want to buy like the drillers are at like multi-year lows. Maybe they've spiked up a little bit recently, but so you'd basically have to invest in them like they're a pet rock, like a commercial mortgage-backed security, and just hang on for a few years. Like with the CMBS, those people are going to have to hold for probably until rates come way down. So, I mean, they're might be upside down for like 5 years or longer. So the banks are like in this big pickle. Commodities, I updated this. We haven't collapsed yet, so that's good. So are we going to go into commodity super cycle? If we don't, that means inflation's dropping off, and that would be good. I'm thinking we're not going to, just given what's going on in China. Unless everybody starts printing tons of money, we should be okay. So sentiment. So this actually has a value this week. And the interesting thing is prior week, this week, and sentiment just looks at like the mental state of investors. This has gone all green where it was neutral before. So everybody's just getting way more bullish when you compare it to previous week, 1 month, 3 months, 6 months. So everybody's getting really bullish. At the same time, like I showed before, the Vance decline line on the NASDAQ was heading down. So people are going to get their, they're going to get screwed. Same chart as last time for a while. And the numbers, I double checked on this one, and that didn't change very much because I did some math on the triple B minus this, and so it's still in the same range, and we haven't crashed yet. And this implies like before each crash, we get the spread between the triple B and the short-term U.S. Treasury typically goes close to zero. And I updated this. I drew the line in here down here because we actually are going farther negative. Like this is like wild, and this is the 10-year note, what people earn when you invest in a bond, and you get payments every whatever period, say every year over 10 years, and then eventually you get the bond at maturity, full value. And it's minus the 2-year, and it's way negative. Typically a 10-year bond would offer a higher rate than a 2-year because the duration of it. Yeah, this is like, it's wild. I threw this one in here. Tom McClellan, S&P 500. compared to M2 divided by GDP. The interesting part is the M2 divided by GDP just tanks, and typically he will push this all forward like 12 months. The red line, I think he pushed it forward too far, but the point is the market usually drops pretty hard after it's dropping down, and so we'll see what happens there. It's just a lot of things don't look good. So we're essentially, there's a philosophy invest in, and there's quad 1, 2, 3, and 4, and I'm not too familiar with it, but I know it works. And we're in quad 4, and that means growth is slowing. And this basically goes and explains like the areas typically people invest in quad 4. Like now it's consumer staples. It says actually tech, and tech has been doing a lot better than normal in yeah, I thought there was more of a write-up on this, but essentially, oh, right here it says growing, whoops, the growth is slowing and inflation is slowing. That's typically quad 4 invest in. So you could review this, pause it if you're interested in understanding that. And then here this is quad 4 opportunistic. So you're going up, and then you go down. So we're about to go down the side of the tree. That's quad 1, 2, 3, 4. We're at the top. So I have my list. I mean, this list, like the way I'm looking at it is, you know, cash is king today, and that's all. I'll leave it at that. Rates went up a little bit on the 3-month. We can see the 2-year at 4%, or the 10 years at 3.5, and the 30-year bonds at 3.7%. So you could earn more money on a 2-year, and then you could earn 4.8 on a 3-month T-bill. So the yield curve is inverted. Gold is setting up. It's about to break 2,000. Likely you're going to see it run 50% up through 2025 is my guesstimate. If they don't close down Bitcoin, you're going to see that surge well above 100,000. Yeah. So same old, some of the same stuff. Valero, PBF, Nucor, added Oxy. Not happening yet, unfortunately. China. Not a lot of new things in here. Bank puts. I do have some puts on the banks. Not much, but just in case things blow up. It's always good to be hedged. And yeah, you can review this. RV stocks, coffee, banks, Roku, Bill.com. Yeah, there's a lot of companies that are like, they need a lot of financing to continue to move forward, and with the banks contracting and money supply and banks going away, there's a lot of these tech companies they're going to struggle going forward quite a bit. All right, we're getting there. Woohoo! Hopefully I wasn't too long-winded or boring, because I was just focused. So looking at commodities, what do we got? Let's find our friends. Where's Mr. Egg? Mr. Egg. So ag as a whole, year over year is actually looking good. Inflation is dropping year over year quite a bit. We have, let's call out a few. Palm oil down 37%, milk down 23%, sunflower down 54%, butter down 26%. Potatoes up 47%. What's up with Mr. Potato? So potatoes, and let's see, where are we? Coffee down 21%, but for the month it's off 6%. For the week down 2%. I thought coffee was, I know for the quarter it's up. It's because this has weekly, monthly, year over year, not year to date. Lumber's off 63%. Oh my gosh. Tin down 40%. It's like everything is down. The input, cattle's up a little bit. Eggs are up 37%. Salmon's up 33%. So there is a little bit of food. But as a whole, inflation has dropped way down. So I don't know why the Fed's raising rates. That's my take. Rates shouldn't be raised anymore. They should be cut. Appreciate your time. This is Green Bicep. Be smart, be safe. Cash is king right now. You get the signal here. Signal from the noise. Thank you. Subscribe. Give me a like if you like the content. And we'll talk next week. Appreciate your time. Bye.